Good afternoon and welcome this afternoon to Short Vertical Spreads, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend James Boyd, who is also fellow educator, 20-plus year veteran of the financial market, and a good friend. And he's there to help facilitate the conversation out in the chat. We're glad to have all of you here with us, whether this is your first time or whether this is your 100th time. And whether you're watching in the live or the recorded version, it doesn't matter. We're glad to have you with us. Be a part of the conversation. Chat in your questions along the way. James will be there to help answer those questions, and I'll try to keep an eye on them as well. If you are in the recorded version, leave us a comment. We'll get back to you as quickly as we can and answer any questions that you might have or respond to any comments that you might have. We're going to talk a little short verticals today. I'm going to talk about a couple of different time frames, and it really speaks to the way that some traders, and myself included to a certain extent in this case, view short verticals as opposed to perhaps more directionally focused long vertical spreads or other types of directional strategies. And that's around the idea of kind of an emergent event, things that might potentially be happening. And it also plays into volatility. So we're going to talk about those concepts as we get into this discussion, maybe a little bit of 0 days till expiration discussion. I've got a couple of examples that I want to look at that are illustrative and educational examples. Speaking of that, a couple of quick housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only. Remember that none of this is a recommendation or any kind of advice. Remember that options carry a high level of risk that's not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. These are multiple leg transactions. Multiple leg option strategies will involve multiple transaction costs. Spread trading generally must be done in a margin account. And short options can and potentially may be assigned early, may receive early assignment, which means that the buyer of that option on the other side of the equation has chosen to exercise their right. That's whether it's a call or a put, whether that's in the money, at the money, out of the money, whether you are further away from expiration or closer to expiration, that is a possibility that exists. So we'll talk about that. Now, in the Paper Money platform on the desktop, the Thinkorswim desktop software application, which is what we're going to use, the Paper Money platform does not facilitate the early assignment of short options. So just be aware of that. As you move your practice from paper trading to live trading, recognize that neither one of those practice ideas is a guarantee of future success out there in the real world or what the market is going to do. In fact, technical analysis, probability analysis, all of those methods of analyzing the market, none of those are guarantees either. Those are all theoretical in nature when it comes to what the market might do. And remember that investing involves risk, including the loss of principal. Now, when we talk about things like rolling an option strategy or rolling an option trade, remember that that's not a magic wand. It doesn't eliminate transaction costs. It depends on the liquidity of the target expiration and strike price. So keep in mind those characteristics. Also, again, the examples that I have today in that 0 days till expiration time frame. A couple of quick reminders about that. One is, as you get down to the last day prior to expiration, recognize that there are some additional potential risks that need to be paid attention to, especially volatility and gamma risk. And in fact, in some cases, initiating a trade or attempting to initiate a trade in the day of expiration or even the day prior to the day of expiration may not be allowed, depending on market conditions and account types and so forth. So that's something to pay attention to. Now, these examples that I'm going to look at today are examples using index options and specifically European style index options, which don't allow for early assignment because those options cannot be exercised until expiration. So we'll talk about that as we get into these examples, but be aware of those characteristics. In fact, I teach a webcast on Wednesday afternoons on trading index options where we discuss exactly those circumstances. So I want to do this really quickly here. Give us a sense of where we are headed. We're going to talk about short verticals. We're going to place some and look at some example trades and discuss some of the characteristics of those trades as we put those trades together, and maybe look at rolling those trades or taking those trades off. But I wanted to do this kind of just general comparison to short vertical spreads. Talk about short vertical spreads. Generally, they are an income generating strategy, not so much necessarily a speculative strategy. You're not looking for directional price movement. You can structure them directionally. A vertical spread creates a break-even price that may be different than if you were just buying or selling the stock, or buying or selling a call option or a put option by itself. The gain in a short vertical spread is limited to the net credit that we bring in, and generally these are traded over a short intermediate time frame. But there's some potential risks here. One of those potential risks is the difference between the two strikes minus the credit is the max risk in the trade. Theoretically, talk about one of those circumstances where that might not be. And the max gain in the trade is the credit received for selling the spread. So pay attention to some of these things as we jump into this. A couple of quick questions. Ricebird's asking the question, 0 days till expiration options, are those considered to be day trading? So if you were to open and close a transaction within that 1 day time frame on the same instrument, then that would count towards that day trade count. If, on the other hand, in most cases, that trade is opened and then it expires worthless, then that closing trade is not going to count against that day trading count. That's not always the case. So just be aware of that. And again, that this is a strategy as we talk about it as we get into this, that is not suitable for all investors. Please have an understanding of the strategy before considering trading that strategy. It's a strategy that you could potentially practice in paper money, but recognizing that paper money does not facilitate the early assignment of short options, recognize that there may be some mechanical differences in how that trade is resolved in the paper money platform. So let's do this. Let's pop out to the thinkorswim desktop software platform here. Let's see what's going on in the market really quickly as we're getting down towards the end of the day. So the SPX continuing to move to the downside. I'm going to pop into a little bit shorter term time frame just to kind of see what is going on. We had a little bit of a bump a few minutes ago. Now back down to kind of that low for the day so far, and maybe pushing even a little bit lower, although we are getting maybe a bit of a bullish divergence on the RSI here, although that's likely lagging. So if we start to see a breakdown through this level right here, again, continuing that push to the downside, and we're starting to see that kind of happening here in this particular case. If we look at the NASDAQ rallied a little bit higher and then sold off. And if we look at the shorter term time frame here in the NASDAQ, similar scenario, higher low in the RSI, slightly higher low in price action over this time frame over the course of the day, not down at the low quite yet. If we look at the Russell 2000 starting to see a big solid red candle down day today. So some follow through in all three of these indices. Let's take a look at this on the shorter term time frame to give us a sense of directionally what this is doing. And in fact, this is breaking below those intraday lows at the moment and pushing to the downside. So SPX, NASDAQ, Russell, all three kind of pushing to the downside. But all three giving us a little bit of this bullish directional divergence in terms of RSI, but that may not be enough to keep that downside movement. So if that's the case, then we could potentially look to take advantage of two things that are occurring here. One, directional downward movement, and two, if we pop over to our VIX grid, in this particular case, taking a look at the fact that volatility is quite a bit higher right now than it was this morning. I started talking this morning in our Trader Talks webcasts Trader Talks in today's market webcast, and volatility was a little bit lower. It has now increased. That may be a good question because we have a number of regional bank earnings announcements today and yesterday and going into the end of the week. We're kind of in the middle of that regional bank section, which is, again, why perhaps the Russell 2000 is pushing to the downside. So implied volatility spiking or moving higher. Not necessarily a big, huge spike, although it is the biggest spike that we've seen in a little while. It is the biggest spike that we have seen in the VIX since into May, June timeframe. So that's not something to be discounted. But for a short vertical spread trader, that is something that could potentially be used to take advantage of the scenario that exists. Because high implied volatility and falling tends to benefit the driving leg of a vertical spread. So volatility movement tends to help the driving leg of a vertical spread. So trading long vertical spreads, that's benefited by generally low and rising implied volatility. So when implied volatility was down here and now it's starting to rise, man, that's making those long vertical spreads more expensive. But when we sell a lot of volatility, when we sell high volatility, we want that high volatility to drop. And we want it to drop pretty quick. And so high and rising implied volatility, not a great place to look at selling a vertical spread, only in the sense that if it can go higher, that's still working against us. But volatility being what it is, volatility being generally a mean reverting instrument, we could make the argument if we were to draw a line in here across these highs on the VIX, that volatility generally, when it gets up into this 20 handle, starts to collapse a little bit. Now, remember, we're in the beginning of the earnings season. We're just starting to get rolling there. Volatility may stay a little bit elevated. We've got some political rhetoric around that last week and this week is kind of creating some volatility in the market. That's keeping that volatility relatively high. Nevertheless, the immutable laws of supply and demand come into play. When implied volatility is high, implied volatility gets sold and prices tend to go down. Prices for options tend to go down. So high volatility is met by selling, and implied volatility typically tends to come down, not only on an individual basis, but on a market as a whole basis. So my thought was, let's take advantage of something like this. I'm going to pop into my single grid here for just a second. And this single grid is a tool that I use, just a sandbox. This is the XSP, which is the S&P 500 mini index, same as the SPX, just smaller, right? Same component, same movement, just a smaller notional value, if you will, in this particular index. It is also, however, as opposed to, say, for instance, an ETF or something, or an individual stock, this is a European-style cash-settled index. So what my thought was in looking at this movement today is, given that there's some downside momentum that we had talked about, and really not necessarily looking for this to make much of a movement, just to stay in that downward direction, not a lot of lift to this market. Now there was some news. I mean, we've got, again, political rhetoric coming out. We've got Fed speakers that have been talking all day, and yet we're still seeing this downward momentum. So my thought was taking advantage of that scenario. So in creating short vertical spreads, generally the philosophy might very well be considered to be sell them where they ain't. We just started hockey season here in Utah. The Utah Mammoth played their first game last night, and it reminded me that Wayne Gretzky used to talk about skating to where the puck was gonna be and not where it is. And that kind of always has reminded me of what I want to look for as a short vertical spread trader. I want to be looking at selling a short vertical spread where the price of whatever the instrument is not likely to be. So if that's the case, and I'm looking at something like the XSP here, with the XSP, kind of being in this downward momentum, I want to look at selling a vertical spread somewhere around where that's not likely to be. So if it's going down, I want to be selling above that level, and I want to be selling at or above a general area of, in this case, resistance, if I'm selling against that downward direction. So I've got a general level of resistance here. Notice the kind of big middle section, maybe just about the midpoint of that big red candle, kind of falling right around that 665 to 660 level, or 665 to 662 level, kind of right in that area there. So I'm looking at selling kind of somewhere around that range and expecting that this index is going to continue to move to the downside. And by the way, speaking of that, we've got a feedback survey out there in the chat. James will repost that, but help us out. Help us to make these sessions better by clicking on that feedback survey, letting us know what you think. So what I did in this particular example, and I'll show you what this example looks like on the trade tab first, and then we'll go over to the monitor tab, and I'll show you how it is performing at the moment. But I went to the trade tab, and I said, okay, fine. Here's the expectation. I want to see downward movement. I'm in the last day to go until expiration, and if I'm bearish, I'm going to be selling a call spread. So I added a whole bunch of strikes here so that I could find the strikes that I wanted to trade. I traded actually two different short vertical spreads in this particular case. I'll take a look at the first one first, which is a little bit further out of the money, a little bit less aggressive, but also bringing in a little bit less return. So I went to that 665 strike, which was that 665 strike was that midpoint support on that big red candle. And I looked at selling right at that 665 strike, a call option, creating that obligation to deliver shares or deliver cash at that strike because it's cash settled index. And then to offset the risk, because otherwise if I had left it there, that would have been a naked short option. To offset that risk, I bought a 667. Now I'm doing in this last day till expiration. So there's a couple of things to pay attention to here. Is that one, this Vegas sensitivity, volatility sensitivity gets substantially lower as we get close to expiration, especially in the last day to go till expiration. Theta sensitivity increases, but I also know that this is going to be binary. I know that at the end of the day, I'm going to either have intrinsic value or I'm going to have nothing because that theta is all going to be gone. And that's one of the attractive elements that some traders like about 0 days to go until expiration options. Now, these are European style, which means that this short leg cannot be assigned until expiration, but we're not going to hold it all the way till expiration. We're going to look at closing this trade down prior to expiration. Now, the other option Greek that really becomes significant in this particular case as we get close to expiration is gamma. And when I talk about really significant, again, that's going to be dependent upon the price of the option. It's going to be dependent upon the price of the underlying stock. It's also going to be dependent upon strike price. The greatest amount of gamma or substantial gamma influence is going to come at the money strike. So if you're selling a vertical spread that is far out of the money, selling a short vertical spread far out of the money, you're already reducing a little bit of that gamma risk. But it's still there, and it can get big very quickly if the price of the underlying instrument begins to move. So I'm short the 665 and I'm long the 667, a $2 wide short vertical spread. And my expectation is very simply that the XSP is going to stay at or below 665 through expiration. Okay. So Noodlebrains asks the question, well, wait a second, isn't it hard to get a good fill on XSP? And I would argue that it's dependent upon, one, the expiration, and two, the strike. So I've got 2 cent wide bid-ask spreads here on these that are a little bit further out of the money. I've got 4 or 5 cent wide bid-ask spreads as we get a little bit deeper in the money. So yeah, these are relatively liquid and they're becoming more so all the time. They are not necessarily as liquid as other instruments, perhaps or other ETF instruments on the same, that track the same index. but they're not an ETF, and these are European style. So take what you can from that and be aware of that liquidity. It's not always the same, but that's a great question to ask in terms of getting filled. The idea was, the mythology was that, yeah, it used to be that XSP was not a very liquid product, but that does, at least at this point, seem to be changing. Again, not a recommendation, simply an illustrative example of that. So, and in this particular case, I think, Math asks a great question. Is open interest of significant consideration as we get down here to the last few days or the last couple of hours or last few minutes to go until expiration on these 0 DTE options? And, you could make the argument, you notice the trading volume that's going on in these options that have moderate open interest, not a lot of trading volume on these in the money. This is a lot of premium selling by 0 DTE options traders as we get closer to the closing bell today. We're kind of coming down within, an hour and a half or so of that closing bell. These are moderate numbers of contracts, but if you're trading one or two contracts in this particular case, you're going to still be a small fish in a big pond here, a relatively big pond. And there's enough activity. So if you kind of cross-check against bid-ask spread width, these are staying, 2 cents wide generally across the board here as we get closer to expiration. So I would argue, Math, probably not as much as if you were holding onto a trade for a longer period of time. Bid-ask spread probably going to be the bigger consideration. But let's pop back over here to Delta Gamma Theta Vega, and we can see that our Vega sensitivity is really going to be left with a net Vega sensitivity of about 2 cents. So we're kind of taking this back down to the idea of, even though we're getting close to expiration, we're kind of washing out some of that Vega sensitivity because we're A, a little bit further out of the money, and B, kind of down at a point where, that Vega curve is very peaked, and it's especially peaked throughout the day. But early in the day on the 0 day till expiration or on expiration day. But as we get towards the end of the day, again, that's also going to start to flatten out a little bit unless there is significant movement and a significant volatility spike, which we've had, but this is staying relatively moderate. Now, our our gamma sensitivity is pretty high at the at-the-money strike. It's always going to be the highest at the at-the-money strike or thereabouts. So I'm not terribly worried about this. This is kind of working in my favor here. It is starting to increase, which suggests that implied volatility is probably rising at the moment, and that's why one of those things that's happening is that gamma influence is increasing a little bit. Now, I also sold another one, and I said, well, wait a second. Doesn't the fact that it's an index option and can't be assigned early allow me to sell a little bit more aggressively, meaning in this particular case, closer to the at-the-money strike and bring in a little bit more premium? And so I did that $2 wide vertical spread here, and then I did another one that was at the 663 and the 664 strikes. So I sold the 663, bought the 664. Less gamma sensitivity net because I've got a smaller disparity between those two. So I've got about a penny of gamma sensitivity. Larger theta sensitivity, though, because, again, we're stacking up against that that at-the-money strike, which has the highest theta. But again, I'm not terribly worried about theta because I know it's going to go away. At the end of the day, this is binary. It's either going to be intrinsic or nothing. And a little bit more premium in this particular case. So let's go over to the monitor tab and let's take a look at these two verticals. So here's XSP, so here is my further out, my 2-point wide vertical spread. 665, 667 is the one that I sold for 68 cents. It's now trading for 22 cents. The 663, 664 1-point wide that I sold for 43 cents hasn't lost all of that time value yet. It's closer to the at-the-money position, so it's staying a little bit stuck in there. So, in comparing these two strategies, I'm kind of in a situation where the further out of the money of these two vertical spreads, the less aggressive of these two vertical spreads, even though it gave me a lower percentage return, lower absolute net credit for the spread, because A, it was wider, but B, it was further out, so my premiums were a little bit lower, is actually paying off a little bit better here. It's giving me a better, larger percentage return, even if I were to close it out right now, which I'm going to do right now, so that I'm not holding this all the way through till expiration. Even though it's likely to expire worthless, news can happen at the end of the day. News can happen in those last few minutes. And what many, I don't know most, but many zero DTE traders will look at being out of positions before that last hour of trading, or at least the last 30 minutes of trading on a daily basis. Now, what's going to happen is that would then count against my that trade count if I were potentially subject to those pattern day trade rules. That's going to count as a trade, one of those day trades, because I'm buying it and selling it, or selling it and buying it in the same day. But I'm going to close this down. I'm going to close down. So you see, this one's 68 cents and I can buy it back for about 17. This one's 43 cents. I can buy it back for about 26. So a little bit more than half here, a little bit less than half right here in terms of what it can do for me. And you can kind of see how that's bouncing back and forth here really quickly. And again, that's that volatility coming into the marketplace. So I'm going to right click and I'm going to create this closing order, and I'm going to buy it back. And we're just going to look at taking this off. It's done the majority of the work that it can do. It doesn't really benefit me to hold on to the potential loss in the trade, which was $2 minus the 68 cents that I brought in. So about 140 bucks against the $68 that I gained in the trade. I'm still carrying that risk for the sake of another 15 cents, and that's not a situation that I want to get into. That's picking up nickels over on the on the railroad tracks, and so I want to do that. So I want to close this trade down. Again, I'm going to just create a closing order. We're just going to buy back the vertical spread that we sold to begin with when it's done the majority of the work that it can do for us, and we'll see if that fills. It filled at 16 cents. So this is one of those areas where the admission we have talked about in so many different places, in so many different ways, of considering you can do what you want, right? Because we don't make recommendations and we don't give you absolute rules. But the idea of closing trades down prior to expiration positively, so that you aren't holding on to a significant amount of risk for the sake of just a little potential additional gain, is one to definitely consider in a situation like this, especially if you're doing zero DTE options. So I'm going to close this one down as well, even though I'm recognizing that the closer, more aggressive one, which abjectly brought in a greater percentage return for the width of the vertical spread and had, on the outset, more credit, isn't working as fast as the one that was a little bit further out of the money. And that may be the fact that the index itself, the XSP in this case, is kind of backing off a little bit. It had been pushing more to the downside, but volatility has been increasing. So that's kind of keeping this one elevated a little bit because it's closer to the at-the-money position, and therefore that extrinsic value is staying there for a little bit longer. So I'm going to try to close this one down as well. We'll buy that vertical spread back. We'll see if we can get it for about 20 cents. And we'll buy that back, again, reading through the order, make sure that that's what we want to do to make sure that that's closing. We'll go ahead and hit that close, and we got it for 20 cents. So we closed it down. All right. So that's kind of that structure. So Sal asked a question, right? So delta, which is approximation of the percentage chance of being in the money at expiration. There's expected move with implied volatility relative to the days till expiration. Which of those is more reliable? And that's a good question to ask, because if we think about DT, or about delta, so we can put in our option layout, we can customize our option layout. Let's do this. Let's customize a column set. and let's do IMP, implied volatility, and click on OK. And now you see that each one of those strike prices has its own level of implied volatility. So I would argue this, that delta probably gives you a little bit more granularity in terms of the probability, but because this number right here over on the top right, let me just kind of highlight this. This is kind of a sideline. We go to this number right here. That's 46% implied volatility. That's an expected move of plus or minus $3.47. Okay. In that particular case, that's the average for this whole expiration series, for all of these strikes within that expiration today. So it's not as granular a choice as the delta number giving us a probability for that particular strike price. But there's a couple of elements at work here. This implied volatility number right here and that expected move, which is a proprietary calculation, is almost always a little bit over exuberant in how far it expects the price of the underlying to move. So the reality or the realized volatility is oftentimes less than the implied volatility, and that's okay. So that gives me at least something that I can use to measure, and then delta gives me a measurement of probability. So I would argue use both of them. Use both of them in that particular case. Yes, Noodle Brains, I had already put those trades on earlier today, and I bought those back. I bought those spreads back to eliminate them. So good, Kappa. How did I determine the strikes for buying back the spread? I just simply created a closing order. I had already created the order. The order was working. And then I just right-clicked on the monitor tab and created a closing order to buy them back at those strikes. So if I sold the 663 strike, I got to buy the 663 strike back to close it down. Likewise, if I bought the 665, I have to sell the 665 to close that trade down or close that leg of the trade down. If you sell something to open, you got to buy it back to close. If you buy something to open, you got to sell it back to close. That's the basic mechanics of options. So those were two 0 DTE, 0 days till expiration, vertical spread, short vertical spreads. And I looked at the direction of the market. We went back to the chart and I said, look, in the short term, because remember, these are short-term trades. This was 0 days till expiration. What was the market doing? Today, that candle was going down. So I was looking at that candle moving on the 5-day or the even today 5-minute chart, and it was pushing to the downside. But remember, Andy, I said that short vertical spreads are oftentimes an expression of event-driven volatility and not necessarily overall directional movement. If I'm more directional, I may see more percentage return by buying a long vertical spread or buying a long call option or a long put option or creating a long diagonal spread, because then I have the ability to take advantage of time and sell premium against that long leg and take advantage of directional movement. But short vertical spreads oftentimes are just a function of riding out direction, not necessarily looking for the price of the stock or the price of the underlying going in a particular direction, just staying somewhere where they're not getting in the way of your vertical spread. So speak truth, I entered those trades probably 9 a.m. this morning Mountain Time. So 11 a.m. Eastern time, roughly, where I got into those trades after the market opened, and I got out of them before the market closed. Okay, so that's how I kind of came to that assessment of these trades and how I put those on. Now, the other one that I was looking at, given the fact that we were starting to see things moving to the downside, and again, news. I don't know if any of you saw the news that came out about PayPal and Venmo and the PayPal stablecoin relationship, and the fact that the PayPal stablecoin, I'm not going to get into the depths of what cryptocurrency is and what it does, but they fat-fingered 300 trillion notional value stablecoin, bigger than the GDP of the United States. And then they burned that off because it was a fat finger error. They can't just create that much without, crashing everything. So they burned that off. But that creates some uncertainty about some of the companies like PayPal, which has an earnings announcement just over the horizon here. So what I noticed about PayPal is this downside move today back down to this level of support. And the other thing I noticed was the fact that implied volatility was relatively high. The RSI was kind of holding its own, but implied volatility relatively high going into the earnings announcement. High implied volatility benefits us as the seller of an option. So what I thought about doing here in this case is creating a short vertical spread down here, short put vertical down here. And I don't care then if this trade continues to move directionally to the downside very much. If it makes a big move to the downside, that's a problem. But as long as it continues to stay out of the way of this short vertical spread until that volatility crushes, maybe past the earnings announcement, then I'm okay with that. So I went to the trade tab for PayPal and I said, look, I know that earnings announcement is going to be right here in this October 31 timeframe because its implied volatility is elevated there. So I created a short put vertical, which is bullish by nature, but I just simply want the price of the stock to stay away from my short strike. High implied volatility going down benefits this trade. So I said, where was the typical move here? I'm going to look at this stock staying away from about this 63 strike. That was when I put this trade on, and when I was looking at this, that was about the 30-cent delta. So I sold the 63. Whoops. Let me kill that. I sold the 63 and I bought the 58. So I made this 5 wide. Whoops, I did it again. Now I'm Britney Spears. Whoops, I did it again. All right, so here's what I'm going to do. I'm going to buy that one right there. Now I've got that 63.58 short put vertical, and I'm expecting the price of the stock to hold that level of support. And even if it doesn't, if it bleeds down through there, it's still okay as long as at expiration it's not below my short strike. So this is, again, a bullish expectation, short vertical spread, but I don't need directional movement. I just need non-directional movement or non-directional movement. I just need it to stay out of the way of this vertical spread. Brought in $1.49 of credit thereabouts in putting this trade on. So I already put this one on, and let's take a look at what this looks like. I went to the monitor tab. Here it is right here. I sold the 63 and I bought the 58. In this case, implied volatility has actually gone up a little bit, so I would have gotten more had I put it on right now. We can put another one on right now. But I got $1.24 for it. It's now trading at $1.49, so it's getting more expensive. But what I want to have happen is this to get cheap fast. Kind of working against me simply because that rise in implied volatility, but I've got a little bit of time. I've got 15 days to go, and I will likely close this, Andy, to answer your question. Look at closing this as implied volatility is crushing, because sometimes volatility will crush prior to the earnings announcement. Now, the risk of holding this to the earnings announcement is that the price of the stock could make a big move to the downside on the earnings announcement, below this level of support that it's tested once, twice, 3 times, 4 times, 5 times at this level of support. It could make a big move to the downside on the earnings announcement. So if I start to see implied volatility pushing down and this getting cheaper, I'm going to look at taking this trade off. I'm not necessarily going to hold it all the way through expiration, expecting that it's going to expire worthless. So I'm going to be looking for this implied volatility to crash, making this option less expensive, making me able to buy this option back cheaper than what I was paid for it to begin with. In fact, we can even automate that. I can say, look, what if I want to buy this back when it's trading at 20 cents or less, 25 cents? So I can right click, create a closing order, and we can look at buying this back at a limit price. If I can set this up as a limit, I'm going to set this up as a limit. So 0.25. If I can buy this spread back for a quarter or less, I'm going to do it because it's done the majority of the work that it can do for me. And I'm going to change that time in force to good till canceled. That way, if we get a crush in implied volatility because of news or something like that across the board or on this stock itself, I don't have to be there watching. Now, remember, it's not set it and forget it. I got to pay attention to this. But if I'm not able to see this, it can potentially tick me out of the trade, which is what I want it to do. Close this trade out, buy the vertical spread back for 25 cents or less, and I get to collect the majority of the premium that I brought in for selling this spread to begin with. If it can do that on a momentary move in the price of the underlying stock or implied volatility, great. But I'm not guaranteeing that I'm going to be able to watch this or that I'm going to see this or this is in fact going to get me out at any particular point. So I've got to monitor this trade. I'm going to go ahead and click on confirm and send. This is my closing order for this vertical spread, and it's a waiting order because it's a limit order because that limit circumstance has not been reached yet. The limit is 25 cents or less, and I'm going to click on send and fire that order off. And then I can come over here to the monitor tab and I can go up here to working orders, and I can see that that order to close this trade down by buying it back for a quarter or less is sitting there as a working order. And that's one of the ways that we can manage short vertical spreads, is looking at buying them back when they've done the majority of the work that they can do for us. There's nothing wrong with that, with buying them back prior to expiration. I don't need to hold this all the way till expiration. I just need to hold it to the point where it's done most of what it can do for me. And I'm not going to get greedy about picking up that additional quarter off of the railroad track because I know that I could get run over by that max theoretical risk that's in this trade if I do that based on news. And think about this. Ask yourself the question, if I'm close to expiration, the stock doesn't have a chance to move, implied volatility is maybe dropped, but now it's trading at 25 cents. Would I look at initiating the same spread for a quarter that I sold for $1.45? Does it make sense to do that? And if the answer is no, don't hold on to the spread all the way till expiration. But we do it again and again and again. So get in the habit. Think about doing this. Practice this in paper money and doing that. If you want to learn a little bit more about short vertical spreads and these ideas, come back over here to the Trader Talks webcast page and look for short verticals. And you're going to see a whole bunch of webcasts that talk about short vertical spreads and how you manage those spreads and how you put them on and how you adjust the width and all of that. How did I find the PayPal trade? As a matter of fact, to be fair, I was watching the Schwab Network this morning. In fact, I was on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, a separate but affiliated company. And the Schwab Network is a great way to see news about the market all day long. You can find it right there in your desktop software platform. You can find it on your mobile platform or on your web-based platform or in its own standalone application. So join us there on the Schwab Network. James is on there. I'm on there. I host a show on there called Your First Trade. And all we ask, though, when you come here to the Trader Talks webcast page, click on that subscribe button. Give us a follow right there. Follow us on X at Ben Watson CS, at James Boyd CS. Oh, and by the way, if you haven't done so already, click on that survey link that's out there in the chat. You may have to scroll up a little bit and let us know what you think of this webcast. We'll see you guys again very, very soon. My thanks to Bree and our great production staff and to James for helping out and all of you for being here on a Thursday afternoon. We'll see you soon. Take care, everybody. Bye-bye.